We are back, and Jim, I'd like to talk to you now and have you discuss the real estate scene. I'm very concerned about real estate. Residential real estate, we know, is really taking a big hit. One of the things on my mind is commercial real estate. I think that might be the next to go, but not all aspects of commercial real estate I think are going to suffer as much. Charlotte and Cornelius and this whole area is very involved in a lot of commercial development. What do you feel, what does the bank feel, and what do community banks feel? Because now that we know that you're involved with partnerships with other banks, what is their take and your take on the real estate development, commercial end of it in this area?
Well, Joe, let me answer that in two parts. Let me touch on residential for a second, because really the residential is what started the slow up, if you will, the decrease in residential sales. And really that the music stopped on that very suddenly. And any of your viewers who are in the real estate market, particularly residential, if they're a real estate agent, developer, builder, they know how tough it is. It is very, very tough. I will tell you that we have seen glimmers of hope. The refinancing activity has taken off in a very dramatic way, and that ultimately saves people a lot of money cash flow wise, which hopefully will translate into other kind of business. The other thing that has taken off is the first-time home buyers. The $8,500 tax credit that expires in December, if they don't have a new home by December, has really spurred a lot of activity on the lower end of the market. Now, obviously,
under 200,000 is where I'm seeing this activity.
Exactly.
Right, okay.
Yeah, exactly. And ultimately, unless people who own those first homes can trade up, and they can't trade up unless they can sell them,
That's right.
then it's basically a reverse cascading effect. The high-end homes are really slow right now. There are some sales, but it's very slow. The lower-end homes have really picked up, and hopefully, we'll see that cascade up the ranks, and we'll start seeing better sales in the higher-end houses. Particularly around Lake Norman, high-end houses. If you're on the water, you're certainly high-end, but everything else is tends to be on the higher-end demographics, and so we'll see recovery there probably last. On commercial real estate, I know this is going to sound unusual, but we really have not seen that big of a slowdown in commercial real estate. We have been doing a lot of lending in what's called owner-occupied commercial real estate. Spec real estate, meaning a builder building a commercial real estate on speculation, that's pretty much dead as a doornail.
Somebody building a strip mall hoping that they're going to rent it.
Build it and they will come?
Yep.
Not coming.
It's not going to happen.
Not happening. That's really dead. And banks, frankly, aren't lending on it. Unless you have tenants that can pay the rent, it is very unlikely you can get financing on spec residential or spec commercial real estate. However, on owner-occupied commercial real estate, we're seeing a lot of activity. Owner-occupied is where, let's say you have a dentist, a lawyer, any business really that wants to own their own property and they don't want to rent anymore. They're taking advantage of the low interest rates right now. It's unlikely we'll see rates ever, maybe in our lives.
Oh, this is unbelievable how low they are, absolutely.
And so what we're seeing is a lot of activity there. That dovetails well into what the regulators view as risk. Spec properties are very, very high risk, and regulators hate them. Owner-occupied commercial real estate is viewed as relatively low risk. And the reason for that is, I guess it's self-evident. When you make the loan, you're relying on the business income to pay you back. The real estate itself is only secondary collateral, whereas when you loan on speculative property, the only way you get paid back is that speculative property, and that's a much higher risk.
So basically, you're loaning to the business, and like I said, the real estate is secondary. So if the business has to be healthy, so when you extend credit to a company who's coming in, or an owner-occupant, you're looking at their business plan, seeing what their background is, seeing what their history is, and the real estate is collateral. Hopefully, you won't need that collateral down the road.
And you really look at it, if you are a business person and you have 2 or 3 or 4 years of business track record behind you, and you're currently renting, and assuming the property is a location you actually want to stay at, this is probably an ideal time to be talking to a banker about that, because they're going to be receptive.
Well, taking your business and building a building and relocating your business into your own building.
That's right. That's a very good option.
You keep mentioning regulators. I mean, there's been a lot of talk about the SEC. They dropped the ball with Madoff. They're dropping the ball with a lot of things. And regulations, there are no regulations, according to what everybody's saying, according to the Finance Committee. Do regulators actually come in? How often do they come in and check
That's
out?
That's a great question, because I'll tell you, the perception is that it's an unregulated business. The fact is, if you look at the businesses that got in trouble, Lehman Brothers, Bear Stearns, AIG, Fannie Mae, none of those are banks. Okay? None of those are banks. The banking industry is very, very highly regulated. Now, one of the other parts of that equation that's not, in the past was never regulated or not regulated heavily, was like mortgage banking.
Right.
Okay, so you could be a mortgage banker.
Well, I was in that gray area. It really wasn't a bank, and they were just go-betweens.
They were go-betweens, and consequently you had a lot of problems with subprime lending, et cetera, in that area. But banks themselves are very highly regulated. We are audited every year. We have outside auditors, people we hire, okay, so CPAs. You have the regulators, the FDIC or the state, they come in every year to audit you. You have what's called consumer compliance audits, which tend to be the FDIC or the state, but an entirely different audit group. They come in every year to audit you. So basically you have auditors almost all the time. And the big banks, believe it or not, and I know this, you don't get this from the newspapers, or I don't want to pick on the newspapers, but you just don't hear about this. They tend to have regulators in their banks full-time, year-round.
Is that right?
Yes. So the issue of regulation is a tricky one. You have parts of the business, lending for instance, deposit gathering and taking, and the rates you pay and how you do it, are very heavily regulated. Other parts of the business, parts that community banks don't operate in, investment banking, those are much less regulated. Now, where you hear a lot of the problems are in those much less regulated
They
areas.
should be regulated more.
And I'm sure they're going to be
They're going to go back the other way.
Right. But you have companies like Goldman Sachs, Morgan Stanley. Those were not banks. They have now adopted bank charters for a lot of reasons, but one of the things that's happening is when they adopt the bank charter, now they're going to be heavily regulated.
Right. This whole scene is going to change.
The whole scene's going to change.
That's why I think we're going to move back towards community banking.
Well, I think you'll see that community banks have been, the vast majority of community banks, there's 8,000 banks in the country, so you'll hear about problems here and there in that community bank or some other one. But the fact is there's 8,000 of them, and the vast majority of them are doing pretty well.
We're going to take a break, and we're going to come back. I want to get it back into this conversation as far as small businesses and how community banks really can help small businesses.
Very good.
Okay?